log scale gold chart and you see these ratio moves, well, if we went up eightfold, it'd be $8,000 gold. And that would be merely replicating the two prior bull markets. She's not pounding the table and saying, oh, we do it again. Well, we don't have a do it again situation here. We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold. And that wouldn't be off the page. I think a lot of it could occur if the stock market starts to break in the first quarter coming up and you start to get that money flow. A lot of this could occur during the next year.
The gold market experienced a record-breaking year in 2024, with prices soaring to unprecedented highs. As the global economy faces continued geopolitical instability and inflationary pressures, many market experts predict that 2025 could bring even more significant developments for gold. Notably, demand from Asian consumers surged, helping to drive gold prices to record levels early in the year. Central banks, too, played a crucial role in purchasing gold at an all-time high rate during the first half of the year. One of the most remarkable milestones of 2024 was the price of a 14-kilogram London Bullion Market Association good delivery gold bar exceeding $1 million for the first time. As of late 2024, gold prices have maintained strong support above $2,600 per ounce, marking an impressive 25% rise for the year. At their peak in late November, prices had jumped over 30%. Recording their most substantial gains since 1979. Michael Oliver, a momentum structural analyst, highlights that gold tends to follow distinct patterns during periods of financial uncertainty. For instance, in the 1970s, gold prices surged from $35 per ounce in 1971 to over $850 by 1980, an eightfold increase. Similarly, between 2001 and 2011, gold's value climbed from around $260 per ounce to nearly $1,920 per ounce, reflecting a similar dramatic rise. These historical trends suggest that gold could experience another substantial rally if inflationary pressures persist. Given past performance, Oliver predicts that the possibility of gold reaching $8,000 per ounce in the coming years is a real prospect. If gold follows the same growth trajectory seen during the inflationary periods of the 1970s and 2000s, this price surge could be within reach. However, this potential rise hinges on several key factors: the continuation of global inflation, expansion of the money supply, and an ongoing global preference for gold as a safe haven asset during times of uncertainty. We will present clips from Oliver's interview, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
And ultimately, the government doesn't control things. I mean, it likes to nudge things, poke things. Hopefully, the Fed likes to think they can take this price, hold this price level steady in this category and let that one go down. They don't like commodities going up. That kind of inflation is bad. But they don't mind when inflation drives stock prices up because they don't call that inflation. And yet it's nothing but a river flow of money they created. It went somewhere else other than the commodities. Right. Well, that flips. You go back to the late 70s, we were in a recession, stagflation. Fed raising rates dramatically in late 70s. Commodity prices were exploding. Well, the stock market was a total wasteland. No, they didn't explode as much as gold, but they went up strongly with gold. And I think this time around, they're set to go with the next power leg in gold. I think commodities are set to participate. And they've not always been in sync with gold at all. Sometimes they're quite opposite. In fact, over the last couple of years, gold doubled from 2015 bear market low to 2020, doubled in price. During the same years, Bloomberg went down. When did Bloomberg explode? After gold had peaked and went sideways, Bloomberg then exploded. Okay, totally out of sync. The last couple of years, Bloomberg's drifted down, about a 50% correction back to its bear lows and then gone sideways. Gold's gone up. So, but I think they're now set technically to hold hands and go together. Why? Primarily because the money will flow out of the massive asset category into that which is perceived to be low risk, higher reward, period. Gold is not some headline chasing market. In fact, if you sell gold or buy gold based on some kind of war news or some kind, the election outcome news, that kind of thing, you're stepping into it, okay? It's likely to blow up in your face. So if you shorted after Trump got elected, you're losing in gold, as much as $100 right now. Uh, so you don't do that. Gold moves on broader glacial reasons. And again, look at an M2 chart, go back 50 years and take a look. The gold will oscillate that money growth, but it'll stay in tune with it. They degrade the money, gold's going up. And if they have more excuse to degrade the money because they need to hopefully stop price collapse in this sector or that sector, banks, financials, commercial real estate, they'll do so when the chief beneficiary is the monetary metal, because it is money, and it's been that way for 3,000 years. We may have forgotten about it, but a lot of the world hasn't. And I think suddenly when the American public, which is not at all bullish on gold, despite its strength year to date, they're not pounding the table. There's no fever in the gold market. That's when you'll see gold start to go more parabolic. Instead of like 3 steps up, 1 step back, it's going to be more like 6, 8 steps up, 2 steps back. And silver will be even more exaggerated. It goes up 4 and drops back 2. It's a bloody market. Yet year to date, silver's up, about as much, if not a little more than the S&P. In fact, 3 days, maybe it'll be up more than the S&P. So it's not a loser from an investor's perspective if you get in at the right spot. That's what I'd be looking for. And I think it is smart money. Obviously, somebody's buying it. And it's not just the Chinese. There are large American investors who've been buying into that sector.
Yeah, and it's your Ocellas and Costco buyers.
Well, not just them. Large investors who are buying into the mining sector. And the mining sector is really a dog. Okay, now you can say that. What a dog. Gold's above the 2020 highs. So it was just 2070, right? Mid 2070 was the summer of 2020. We're now 2,640. Okay. Meanwhile, the gold miners, using GDX, for example, which is not necessarily the best metric, its high back then was $45. Right now it's trading 34, 35. So yes, it's up year to date, a nice percent, not as much as gold or silver, by the way, but it's not got a fever in it, that's for sure. And we're arguing that you got to watch that dog sector. Because once you break the stock market, there are investors who are not going to go out and buy silver bullion or futures contracts or triple long silver and bullion ETFs or anything like that. They're going to buy stocks. And some of these stocks have decent dividends, by the way. And so they're going to move out of this stock and into these stocks. And they're going to move into that gold mining sector. And it won't take a heck of a lot of money flow to bloat that sector off the page when suddenly you get public interest in it. I think it could be far more dramatic than anybody can technically project and far more rapid. Once the stuff starts to unravel that we've been talking about, that will fuel gold. And once it becomes almost the sole good alternative and people suddenly realize, my gosh, it's been a better place to be actually year to date. And I'm all fevered over this market and wasn't fevered over gold, and yet gold beat them, and nobody's pounding the table. Then suddenly it starts to go vertical because the river flow of liquidity. And that's where you want to be. Now, where might gold go? Well, if you go back and since it was legalized, 75, we had a move, went up to $200 in early 75, as soon as we opened trading on the futures, dropped down to 103 by the summer of 76. Okay, summer of 76 to early 1980, went from 103 to 850. You do the math, eightfold, okay? Go back to 2000, gold made a reaction low at about 260. Over the next 11 years, it went to 1920, almost an eightfold move. Okay, so when you look at a log scale gold chart and you see these ratio moves, well, if we went up eightfold, it'd be $8,000 gold. And that would be merely replicating the 2 prior bull markets, which is not pounding the table and saying, oh, we'll do it again. Well, we don't have a do-it-again situation here. We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold. And that wouldn't be off the page. It's hard to come up with a number. I do think, though, it should be speedy. In other words, I think a lot of it could occur if the stock market starts to break in the first quarter coming up, and you start to get that money flow. A lot of this could occur during the next year.
The Federal Reserve's decision to cut interest rates by 25 basis points on December 18th was no surprise, as economists widely predicted it and reflected in interest rate futures pricing. However, the more significant development was the Fed's Summary of Economic Projections, SEP change, also known as the dot plot. This adjustment showed that policymakers had raised their projections for GDP growth, inflation, and policy rates for year-end 2025. Notably, the Fed now forecasts only two 25 basis point cuts in 2025, which raises the median year-end federal funds rate by 50 basis points compared to September's projections. The hawkish tone of Fed Chair Jerome Powell's remarks particularly caught the market's attention, where he stated that additional rate cuts would require further progress on inflation. This led to a rise in U.S. Treasury bond yields and a near 3% drop in the S&P 500. Despite the initial market reaction, a pause in rate cuts seems prudent, as it aligns with the Fed's broader economic goals. Investors should focus on the economic strength guiding these policy shifts, recognizing that while inflation remains a key concern, the underlying economy continues to show resilience.
Stock market. That is a rare event in bear markets in the first place. So I know a lot of gold bugs are panicked about the notion, well, if the stock market goes down, gold will go down. Well, it's actually not true. Historically, it's not true. As I said, like 100 years, look at the 29 to 32 bear market in the stock market. There was no gold trading then, but you could buy Home State Gold Mine. It went up 1,000%. Well, the stock market was decimated. And it took the stock market another decade and a half just to get back to the price high it had in 29. And during that time, gold was a better place to be. Mid-70s, gold was a better place to be. It went to its high in 1975. Well, the stock market was imploding. Okay, the 2000 dot-com top. You had an 82% collapse in the dot-com sector, NASDAQ 100. Gold went up during that time and continued up for another 10 years. 2007, stocks peaked when they started cutting rates. September, October 2007, the Fed cut rates for the first time in a couple of years. That was the top. They cut rates all the way down. Gold went up, with some exceptions, a month here and there. But basically, the trend was opposite. So I don't think that's going to occur. Yes, gold could go up if the stocks continue up, but we are highly, highly doubtful that stocks are going to make it probably through January or February even, in terms of jolting the market enough to where people say, my gosh, what happened? It takes a bit to do that. Now for momentum, it doesn't take much to break the backbone. But for price, it takes, you get a 10, 15, 20% drop. Now, the funny thing about that is there are a lot of skeptics out there of the stock market, sober analysts who look back at history and look at various valuation metrics and so forth and say, this is a bit done, boys. This is way overdone. And they're calling for a, quote, correction. Well, correction's what, 20%, right? Like that's the standard. Okay, you don't want to go 20%. You go 20, you're going to go 50 or more. Okay, because why we can see by momentum structures below the market, particularly annual momentum, when we measure not just versus 3-quarter average, but a 3-year average. You can't drop 20%, you'll blow it. You blow quarterly first, and then you'll blow annual. So you cannot have a correction in the stock market. If you're a bull, you don't want it to even hiccup at this point. If it even hiccups, it's going to break its backbone, and the money will flow into gold. We can understand the fundamental underneath that. It's not so much whether the Fed cuts rates or not. That's not an issue. In fact, there's plenty of times in the past when you've had a bad stock market, the Fed's been raising rates, like the late 1970s, for example. Rates were going through the roof. So did gold. So what really matters is the monetary policy and the aggressiveness of monetary expansion, Fed balance sheet, and panic on the part of the central banks, because then they put the pedal to the floor. One aspect of that might be rate cuts, but that's really not the essential. The essential is the monetary expansion. I suggest to your listeners, go to the Federal Reserve St. Louis site and look up M2, and you'll see a chart. And there was a pause and a dip a year or so ago. It's accelerating rapidly right now. Monetary expansion is back into full throttle for the last year, going vertical again. So they're concerned about something. And if you rattle their cage, they won't show it in their face and in their press conferences, but they'll do it in policy. And that's what drives gold ultimately, the degradation of the money unit, global market. Because I think the crisis that's about to hit is we've had for the last 100 years, ever since the Fed's been around, meaning an entity that has the legal monopoly over the quantity and the pricing of money. Okay, what's money? Well, it's the most essential commodity between you and me or any businessman, somebody manufacturing something in this part of the world and selling it over here. The medium of transaction is unit of money, yens, euros, etc., dollars. And as long as those units of money are degrading in real buying power, ongoing, and they are, meaning, forget what the dollar looks like versus the yen or the euro. Those things can fluctuate. The real issue is the total degradation of the money units. Well, the dollar, you look back at the M2 chart that I mentioned, go back 50 years, take any 10-year segment of that and check the numbers and see how much it grew. Basically, almost doubled every decade, the quantity. Right now, it's even a faster pace. Well, if something doubles in quantity, it reduces its real value by about 50%. So if you bought a stock at $10 and 10 years later it's 20, you're not really making any money. What did your parents pay for a house? What did your granddad pay for a house? You would consider pocket change, okay? What happened? House prices go up? No, the value of the money unit collapsed ongoing. That's what drives gold ultimately. And when the central banks panic because this key asset category breaks, and by the way, all the data points that people like to look at, like unemployment or factory if output, and all these various economic data points that the Fed has now said, don't forget, guys, this is our other mandate, not just quote inflation, but the economy, unemployment. And as those numbers get bad, they shift fully to that mandate. When do those numbers get bad? Go back and look at previous bull market peaks in the stock market. It's rare when you see a collapse in the economic data points and then the stock market goes down. It's the other way around. The stock market peaks, well, you might have had some softening a little bit, but the real drop in those numbers or the negative shift in those economic data points occurs after the stock market has begun to implode. So you can imagine the kind of data points the Fed's going to be looking at in a couple of months if we're right about the breakage in the stock market. So that's what's going to drive gold. And that's why it's important to watch the U.S. stock market bubble right now, because if it does begin to break, and we specify numbers, well before you see anything on a price chart. And by the way, the stock momentum trend structures that we see right now almost overlay, and I don't want to pound the table about this, of the 29 top and the 87 top. The price action looks just as lovely and strong, and yet the momentum structure is like a 2-year wide floor that's at a shallow level. So in other words, it's not oversold when it breaks the floor. And when you break that floor, price suddenly changes from happy-go-lucky to suddenly what the hell happened. And that's when the jolt occurs and the money flees. Anyway, that's where I think we are. And I think we're literally possibly, next year is 3 trading days after today. It starts next year, next quarter. And that's when these numbers shift. And I can tell you that literally 2 to 3% below where you're trading right this minute, you don't want to be next quarter.
Michael Oliver is much more concerned about the Federal Reserve's aggressive monetary policies, particularly its rapid money supply expansion, which has become a critical factor influencing the current financial landscape. Over the past few years, the Fed has been increasing its balance sheet and expanding the money supply, leading to a significant devaluation of the currency. As more money is printed, the real purchasing power of the dollar diminishes, making it less valuable over time. This inflationary trend creates a favorable environment for gold, as investors seek to protect their wealth from the erosion of the dollar's value. Historically, gold has proven to be a strong store of value during periods of excessive monetary expansion. Oliver believes that when central banks, like the Federal Reserve, engage in massive monetary easing, it often signals an underlying crisis or impending financial shift. While the Fed's actions may not directly result in a market crash, they increase uncertainty and create a backdrop of instability. This environment drives investors towards safer assets like gold, which retains value even amid volatility in other markets. Share your thoughts on Oliver's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.